Inflation is robbing you. Joe Biden is falling everywhere he goes. And they seem to be canceling everybody's student loans but mine. In these trying times, it is more than clear that all we have is ourselves. And in order for us to really thrive during this next recession, we need to tighten up. A lot of millionaires are made during recession, so now is the perfect time to really figure out how to invest during a recession, so that way when it actually comes in with full force, we're able to take advantage. So make sure you keep it locked for all that and more. It's Crystal with the Cash Compass. All right, welcome back. I can explain why I've been gone, but I will get to that at the end because right now I gotta make us some money. If charts like this stress you out or give you anxiety like this right here, you can invest that method, which would be technical analysis, or we can actually look at the fundamentals. When we're investing based off fundamentals, that is a much easier way to understand stocks versus technicals because you don't have to know the different candle shapes, the different lines, and all the moving average. Like, you don't need to know any of that. All we're gonna focus on is what makes this business good, what makes this industry make sense to invest in, and in layman's terms, is this the right choice for me to invest? So within fundamental analysis, there's two ways for us to look at stocks: top down and bottom up. The top down approach is less risky. So if you're maybe new to investing or you're just risk adverse, this is for you. We're gonna start with the overall economy, the overall world, all right? So we're gonna start globally. Where do we wanna invest? I would say stick to your home country, so which is for me right now is the US. From there, we're gonna look into industries. What industries are performing well, or what industries we wanna actually target? And then from the industries, we're gonna pick specific players in the games of those industries and see if they are a good choice. Now, bottom up is basically the exact reverse. We're starting with a company in particular. So maybe you've heard about a company that you like, maybe you work this company, maybe you heard some sort of tips, somewhere on the internet saying invest in this, and you want some more information. So we're starting with that company and working our way up. What industry is this company in? Is that industry thriving? Is that industry a dying industry? What about the overall economy and world? Is there still going to be a demand for this industry in the future, or is it getting eradicated slowly? And we're just kind of backing out to get a bigger picture, okay? That requires a lot more expertise. As you'll see, we're going to go through two different examples, all right? So let's start with top down. So like I said, we're going to pick our country. I'm picking the United States. And then from there, we're going to decide how we're going to approach this, all right? There's many ways we can, because we're in a recession and this is investing for a recession, you can just simply Google what industries perform well during a recession. Or if we're not doing it for a recession, you can say, what are the emerging industries, future industries getting a lot of money into it. Just take a look at different things that are going around in the world. What industries have you seen in your own day-to-day life that you might think, this could be the future, right? And of course, you can do this across multiple industries. I would never suggest anybody to put all their eggs in one basket ever. All right, so I'm going to show you a list. I have all the links that I'm going to be mentioning in my bio as always. So let's take a look at the different sectors, okay? So we have energies, materials, industrials, and so on. In recessions, we typically tend to see stronger performance within healthcare, and then within consumer staples, that'll be your groceries, items that we need on a day-to-day basis, and it also includes our vices, all right? So I'm going to go ahead and click consumer staples, and as you can see, we have food, we have household and personal products, and then we have food, beverage, and tobacco. Again, unfortunately, during recessions, times get hard, people tend to drink and smoke a little bit more. So I'm gonna go ahead and click into this, and we're gonna go with tobacco because I feel like it. All right, so from there, maybe you don't know much about tobacco like me. I don't really smoke cigarettes, so I'm just clueless, but I looked up top tobacco sites or top tobacco companies, okay? And as you can see here, there's a top three. We have Altria, Philip Morris International, and British American Tobacco. So I'm gonna go with Philip Morris. You can find out all about these companies' personal business. I actually do this for a living, right? I prepare these financial statements for investors, which is me and you. Do not think investors are only like the sophisticated investors who have all this money. No, these statements are prepared for you and I as well, so we can get a better understanding of what we're investing in. All right, so if you type in whatever the company is, so Philip Morris Investor Relations, for example, you will get all of the investor materials that they give to people. The 10K is our annual financial statement. So it basically shows the performance for the past 3 years, not just 1 year, which is really nice. And that's why I tend to look at 10Ks more versus 10Qs, all right? This is how you should expect it to look. This is the Form 10K, as I mentioned. They have some risk factors, okay? Because if you didn't know, tobacco is a dying industry. So you're probably like, Crystal, why the F would you show a dying industry? There's a lot of regulation, but they tell you that. And this is not fun, it's not sexy, let me just be clear. It takes a little bit of work. It's not really that hard, but it does take a little bit of work. But if you've been scrolling on Instagram, I mean, scroll on this instead. It's much more better for you. So even though tobacco is a dying industry, there are tobacco alternative products that this company is actually investing in. So there is potential, even if one line of their products kind of phase out, they're in the works of developing new products that hopefully won't go under as much scrutiny, okay? But this is still a risk that they might not even be successful even with that, right? So we have to read through their risk and make sure that we're comfortable with them. So this risk says we may be unsuccessful in our attempts to introduce reduced risk products, and regulators may not actually permit them to use this and commercialize it, okay? They're looking to pivot, all right? So there's still opportunity to keep this company alive and switch to less regulated items and products if necessary. So let's take a look at their earnings, all right? So as you can see, earnings have been increasing even after we take into account all the taxes that they get. So it's kind of crazy, but they get heavily taxed on their products, right? So, but even considering putting that aside, that industry netted, or this company in particular, netted $31 billion, okay, for their sales and their revenue. These numbers are in millions, so we're basically adding 6 zeros to the end of each of these numbers, which is why I said it's 31 billion. That they obviously did not make $31,000, right? So they had net revenue of 31 billion. I thought the taxes were pretty cool to highlight because that's kind of crazy, right? They ended up netting $9 billion. So after all their expenses, their marketing, their, you know, whatever, their payroll, after everything, they have netted $9.7 billion for 2021. And as you can see, that number is increasing year over year. So even though there's heavy regulations, even though they've been taxed heavily as well, and the taxes are increasing year over year as well, they are still extremely profitable. Moving on to the balance sheet, they have $41 billion worth of assets. They have $49 million worth of liabilities. So they do have more liabilities than they do assets. However, we see it's a very profitable company. They're definitely able to take care of their current liabilities based on their current revenues, okay? Moving over to the statement of cash flows. Cash is king. In the income statement that we saw, yes, their revenue is increasing. Yes, their net income is increasing. But as we all know, accounting has a lot of different rules and nuances, and you can actually look like you made no money, even if you made mad money, all right? We like to look at cash flows because it tells you where the actual cash flows, the dollars, where the dollars went, all right? And as you can see here, their net cash provided by operating activities being their day-to-day business, that has been increasing year over year as well, okay? It took a dip in 2020. Everybody took a dip in 2020, okay? But 2021, we are actually exceeding 2019 levels. So we're back where we were, like we never even fell off, right? So that's good. Investing, it's just good to see that they've actually been making some acquisitions. You have this $2.1 billion number. They tell you more details in it in note 6 if you're interested, but we can see that they're investing into their business as well, okay? Another thing that I wanted to kind of include here, which was really good to know, is that they paid dividends. I love dividends. If their stock does not grow in dollar amount, you at least know you're gonna get some sort of growth through their dividend payout, okay? And their dividends have been increasing year over year, at least from the past 3 years. It was $4.62 per share, 2020 $4.74, and 2021 $4.90. So they have been increasing year over year. As I mentioned, that's typically a good sign to me when I'm looking to invest in dividend stocks. All right, so based on that, I mean, to me, that looks pretty good. They have a maybe not so promising future, but they pay good dividends. The dividends are increasing, and they've been having their revenue increase year over year as well. Yes, there's been more regulation. Yes, there's a decrease in demand for tobacco products, but they're looking to pivot as well, and they've already introduced some alternative products to the market. So if we reach a point where regulation was extremely heavy, well, they could hopefully really shift their focus into these products and grow that as well. That's the top-down approach, okay? So we started from the macro. We're trying to figure out what industry would be best for us based on recession and how we can make sure that our investments are still looking good even though when the rest of the world is looking bad. Now let's try the bottom-up approach. Now this is a company called Starwood Property Trust. I actually used to work here not too long ago. I love the management. I know that the company is solid. Let me add, this is not financial advice. These are just companies that I've picked, as you can see, as we're going along. I picked this not only because I work there and I know how good the management is, but it's also kind of a a little rough industry, okay? Because this is not only dealing with real estate, but it's commercial real estate. And as we know, commercial real estate has gotten a huge beating. And as people increasingly want to work from home and companies have been actually on that bandwagon as well, there's less of a demand or a need for commercial space, right? So maybe in the future that might not look too good, but I'm going to show you why I still chose to go with this. And this is exactly why this method also requires a little bit more expertise, a little bit more digging, a little bit more knowledge, but you know you're making really sound investments that can actually thrive no matter what industry it is, okay? All right, so let me just quickly kind of run through what they do. They are a real estate investment trust. Real estate investment trusts have to give out 90% of their earnings, so we know that they're going to more likely than not be paying dividends. Any REIT will pay dividends, okay? So it's a really good mix, in my opinion, of commercial as well as residential real estate. And then they also have another segment that should be thriving during recessions, okay? And one thing I like about them as well is that they're really quick at analyzing what's going on in the economy and actually acting on it, okay? So like we said, commercial real estate has had a little bit of a shaky moment right now, okay? They used to be heavily weighed in the office space, all right? So they've gone from 38% of their portfolio to 29%, okay? Which actually ends up being a 22% reduction in the amount of office space that they've had. And they've actually reduced their retail as well, because we know during a recession, people tend to spend a little bit less, right? So they're forward looking. They've already kind of analyzed and identified these areas as areas that need to be reduced, so they can have a little bit more of a competitive portfolio as we move into the next financial crisis that we may or may not have, okay? They've also increased their multifamily, which is multifamily is like those large apartment buildings, by 117%, and their industrial by 730%. This is just a quick recap of what the industrial sector actually has to offer. So it's about manufacturing and distributing capital goods, aerospace defense, we have electrical in there, machinery, so all the things that we really need to really build up a country, okay? So they've actually had a higher focus on things like this, all right? So that's what gives me the warm and fuzzies when I'm looking at analyzing this company. Taking a look at their assets and liabilities, $83 billion of assets. A lot of that is this VIE, which a little bit too complicated to explain right now. I don't want to get into that, but basically $83 billion of assets and $77 billion of liabilities. So that's really great, right? They're positioned well. They have more assets than they do liabilities. And a lot of their debt is also secured financing, right? So it's like, you wouldn't necessarily have to worry about them defaulting and then not really be able to make their lenders whole, because a lot of their debt is secured, okay? What they do is they'll borrow money from a company and then they'll go ahead and they'll go ahead and lend that money out to an entity, okay, another company. So they're kind of like this middleman. As you can see, revenue did take a hit during 2020. As we mentioned, it was, commercial lending. A lot of things kind of went on halt as we were trying to figure out what was going on in the world. So they did suffer a bit of a dip. We're not back at pre-pandemic levels just yet, but again, they have been doing a lot of kind of shifting and analyzing their portfolio, and I believe it is still showing great growth, okay? And as you can see, a bit of a dip in net income during 2020, but we're right back up again, not quite at pre-pandemic levels, but still in a good ballpark range. They do pay dividends as well. The dividends payout was around 8%, depending on what you actually buy the stock for. So it's paying out $1.92 per share, and the shares are anywhere around like $22 to $24. As we can see here, cash flows is really important to look at, because like we said, there's a lot of, especially within banking, financial services, there's a lot of different rules that these companies can use that might make your financials look a certain way, but the cash doesn't lie. All right, so this might be concerning, because you see that their cash from operating activities is negative $9 million, right? $989 million, which might seem like a lot, but it's a timing thing, okay? Because what they're doing, like I mentioned earlier, they're originating these loans. Well, part of it is they're originating these loans, all right? So they're actually giving these money to these different companies. They're loaning that money out to them, but then they also take those loans, group them together and securitize them, so they get a whole bunch of the loans that they've actually originated, group them together, and then they sell that to investors. So depending on the timing of that, there might be times where it might look like they're not actually bringing in cash, but it's just a timing issue. So that's what happened here. They originated 5.1 million. They got rid of 3.8. So really that's the difference, is that kind of timing. They're waiting. They might be waiting for it to sell. They're waiting for it to properly securitize, and that's what really explains this large negative number, okay? But based on what I know about the company, their direction, and how they're able to easily pivot when they need to, I'm confident in investing in this company. But like you can see, it takes a lot more know-how and a lot more knowledge when you're doing from the bottom up. So the top-down approach allows people to just kind of pick an industry that they think is going to do well, or whatever the parameter you want to set is for that, and then you go ahead and based on what industry you select, you can pick the top dogs in that industry, okay? And that is the basic 2 strategies for investing. And if you watched this long and you are one of my lifelong supporters, thank you so much. I really appreciate you. I have been gone for a little while because I was developing a course. So I wanted to develop a course that would basically encompass what I would do in a one-to-one, but it's a little bit hard for me to do one-on-one because of the capacity I have, right? I have like a day job, I have this business, and I also have a kid. So it's very time consuming. So I packaged what I would be teaching in a one-to-one if I did consulting in a course. So I am really happy and really excited to do that. Please check the link out in my bio. It's going to really help you analyze your money, determine what kind of risk taker you are, and allow you to, based on your risk level, pick and choose what assets will work best for you. There is also exclusive content, things that I have not mentioned anywhere on any platform before, that's super important to help us actually elevate financially. And it's a way to support me. You know, if you really like my work, you like what I do, I want to pull people off of social media. It's nice to have this social media platform, but it's even nicer to have your own thing. And I'll have a video talking about starting a business too, so definitely be sure to subscribe. Things might get a little bit ugly in the next year or so, okay? So we are at a point where right now we can get well positioned so that when the recession does come, we are profiting really well. Mwah. Love you guys. I'll see you next time.